Hi. In this part of Chapter 1, we will talk about accounting in general. What is accounting? What does it involve? Who are the users who benefit from it? Why would we care, or why should we care about accounting? First, what do we mean by accounting? Accounting is the language of business. And why do we call it like that? Well, because it gives a picture of the financial situation of the company. Basically, accounting is an information system that captures economic events for a certain organization, and it communicates this information to those stakeholders who actually can utilize it and can take advantage of this information. For example, an investor who is considering two companies for investment can utilize their financial statements and financial reports in order to compare their performance, and then that investor can decide which one would be more profitable or less risky in order to invest, and make the final decision which one to invest in. Without such information, the decision would be random. Company A or company B, it wouldn't matter, and at that point it could be even split 50-50. However, this is not the optimal solution, whereas using accounting information would enable them to get a better informed decision, to make a better informed decision. Now, another example is when a company introduces a new line of product. Take Apple, for example. When they want to release a new device, how do they decide on how many units they are going to manufacture? Are they going to produce 10 millions, 15 millions, 5 millions? Let's say that the market actually needs 10 millions. If they produce too little, say 7 million devices, they will run out of stock. They are short of more or less like 3 million units. By that, they might even lose the clients who might switch to a different device rather than wait for the amount to be remanufactured later on. On the other hand, if they produce too many, they will end up with millions of devices sitting in their warehouses, not being sold or not being used. That is also a loss. So how do they reach the right amount? How do they make the right decision? Well, they can predict how many units they need to manufacture by looking at previous year's accounting information, such as sales. If they look, for example, at how many devices were sold when they released a new iPhone in the previous years, they can make an estimate, a pretty accurate estimate of how much they also need to manufacture this year. No matter what, such a decision would be much better than a random decision. It would be a better informed decision based on accounting information. Now, the main purpose of accounting is to identify, record, and communicate financial information about economic events. Now, this is the main purpose of accounting. It has 3 steps. First, we need to identify the records of interest. In other words, the events that can be thought of as an evidence of the occurrence of an economic activity, such as a sale, a purchase, or a payment of a bill. Now, once we have identified those records, the next step would be to record those events. Accounting helps us keep a systematic and chronological record of events. It's more or less like a history or a diary of events that can be measured in dollars or other monetary units. Now, bookkeeping consists of this second activity. In other words, it's the recording phase of economic events, and it is, as a result, it can be thought of as part of accounting. However, it's not accounting in general. Accounting consists of the 3 steps. Now, once we have identified the records and the events that are interesting to us as accountants, and once we have recorded them, well, they will be of no use if they just reside on our servers. Instead, we need to communicate this information to the various users who might be interested in such information. For example, you can produce them in the form of financial statements and publish them online, and in that case they can be used for investors and creditors, etc. Now, accountants, they also possess the ability to analyze and interpret the recorded events. So it's not only that they need to communicate the information, but they also need to educate the users on how to analyze it and how to make use of this information. So they usually communicate such analysis in the form of ratios, percentages, graphs, patterns, outlier reports, and in that case they give the user an explanation of what this reported data means and how it can be best used, as well as any limitations associated with that information. The most common form of reports that are known in general are the financial statements, which usually include data that is reported in the aggregate, and by that we mean it's not at a very detailed level for convenience purposes. When we think about accounting information users, basically we think about two main categories. Those could be internal users or external users. Basically, internal users, they use the accounting information to help them make managerial decisions. These decisions, they include, for example, the price the company would want to sell a new product and at which price would maximize the company's income. Another question that that internal users try to answer using accounting information would be, for example, can we afford to increase the salaries of our employees? Can we distribute dividends to our shareholders? For that, they usually need detailed information and detailed reports, which are usually provided by managerial accounting. Now, examples of such internal users include HR, company officers, you have marketing, the finance department, etc. On the other hand, external users are external parties that are not part of the company, and those they might have different interests. Therefore, it becomes somewhat hard to provide reports that satisfy all their needs. As a result, financial statements try to best satisfy these users as much as possible. It's more or less like one size fits all. Now, external users such as banks, lenders, basically we have also tax agencies, governmental agencies, investors, customers, suppliers. All these, they attempt to use these reports, usually the financial statements, in order to answer questions that would be like similar to, for example, will the company be able to pay back their loans or will they default? How profitable is this company? Should I go with company A or company B? What about for example, the income of this company, etc. There are three major areas in accounting. You have tax accounting, managerial accounting, and financial accounting. Tax accounting, talks about policies, tax policies, etc. And those policies are determined by the government. Such policies are not only affected by the economy, but also by politics. And in certain cases, the managers of firms, they try to, or even sometimes individuals, they try to minimize tax payments without breaking the law. So what they do is they report their income for tax purposes, and they try to minimize their income that is reported for tax purposes in order to pay the least amount of taxes possible. That is without breaking the law. In this course, we will not be talking much about tax accounting. We'll be focusing about financial accounting. Now, managerial accounting is, like we mentioned before, this is used by the management, used by companies' management in order to, and by other internal users in order to make decisions and to make the right decisions. Usually, this is not as strict as external reporting or financial accounting because it depends on every company. Every company basically has the right to choose their own procedures and to basically within the company, and they can decide on which kind of reports they want to have. Additionally, usually those reports are much more detailed because they would require more information in order to make their decisions. Plus, it's usually timelier and than the regular financial reports that are filed for external users. Finally, we get to financial accounting, and this is the main, this is the focus of this course. This is where the main focus, the importance here is to make this information available for external users in a standardized way in the form of financial statements, and to make sure that the information is reliable, credible, and comparable across all across various companies.